Now it's time to welcome back in Jeff and, of course, our special guest, Ed Slott. Ed is a public speaker and is well-versed in IRAs and retirement distribution planning. He's also a practicing CPA and has written 5 books, including the recently revised Retirement Savings Time Bomb and How to Diffuse It. Ed, thanks so much for being back here on The Income Generation.
Great to be back with you.
Ed, it's so great to have you today. On the particular topics we're discussing, we're focusing on estate planning. And every day, David and I hear from folks all across the country who are concerned about not creating a huge estate for their kids, but they would much rather, if you ask them, keep their money in the family versus it going to the IRS. And it's a very simple choice. And so what happens is we amass incredible amounts of wealth in IRAs and 401ks and other pre-tax items. But then what happens when we die, Ed? We have a huge income tax. So tell us what you think some of the best strategies are to keep that money in the family.
Well, here's a simple one. Spend more. All right, done. Spend it all, give to charity. But if your favorite charity, like most people, is your family, then you may have to do some things now. And now is still a great time. 2021, we know what today's tax rates and brackets are. We might not know them for 22. So when you say income tax, that's for most people who have accumulated wealth in taxable, or we should say tax deferred IRAs and 401ks. That money has not yet been taxed. So if that money gets passed to heirs, that money will be taxed. That money never got a step up in basis. You know, everybody's screaming about the end of step up in basis, if that even happens. I doubt it. But remember, for most people where their largest assets are in tax deferred accounts, that never gets a step up in basis. No matter where it ends up, whether it's your heirs, your children, grandchildren, whatever, they're going to pay an income tax. Now you can help decrease or reduce that tax hit by, for example, converting to a Roth IRA now. It might cost you some money now, but at least you'll be leaving them tax-free money. Or even better, you might use life insurance. I'm talking about permanent insurance as a planning tool. And just so you know, I know you guys know, but I don't sell insurance, stocks, bonds, funds, annuities, none of that. I'm a tax advisor. But as a tax advisor, after the Secure Act eliminated the big benefit of IRAs passing to heirs through the stretch IRA, I believe life insurance is the single biggest play to actually exchange bad assets for good assets. IRAs, thanks to the Secure Act, and that was Congress's intent, have been downgraded as a wealth transfer or estate planning tool. They just don't work anymore with this 10-year rule after death and all the tax bunched into that period. Better off, if that money is intended for heirs, it's better to take those funds down now over the next few years, use up the lower brackets while they last, and then take the after-tax money, put it in a life insurance policy. The beneficiaries will get larger inheritances, more control, and less tax. And that's what everybody wants. They don't care about the vehicle that gets them there. The old IRA vehicle has pooped out. Now you need to switch to a limo.
Sure, well, you're right, Ed, but when you say, I want to leave an inheritance, it polarizes people. Our viewers, our listeners, they would much rather keep the money in the family than having it go to the government. So maybe we should just say, instead of making it go to the government, here's a way to keep the money in the family. Now, everybody wants to do that because, of course, they value their family more than the IRS does, fortunately.
Well, let me first tell you, if you're leaving money to Uncle Sam, he's not even your real uncle, okay? So that doesn't count as family, if that's where you're getting confused. He's not a real uncle, not a real thing. Your family can get actually larger inheritances with a couple of items I just recommended and tax-free and not have to worry about all these complex tax rules.
Ed, thanks so much. Unfortunately, we need to leave it there for now. Really appreciate you being back on the show. It's been great. And that's something I want to ask our next guest about, Jeff, who's got a lot of experience in this area, and that's Sam McElroy, Chief Executive Officer of Stride Financial in Chicago. And as you know, Sam is an income specialist with our very own retirement income store and has years of experience in helping clients really plan for the exact same types of things we're talking about today. So Sam, it's great to have you back here on The Income Generation.
Absolutely. Thanks for having me.
So Sam, in your experience, do most of your clients understand the importance of having a comprehensive estate plan?
You know, the thing is, Jeff, I would say most of them don't. There's a widely held misperception that only the mega wealthy really need to have an estate plan. And I think that's because people don't understand what happens when you don't have one. And in a lot of instances, people spend a lifetime accumulating this wealth. And if things go according to plan, they should have a considerable amount left over by the time they're out of this world. So you have to have a thorough idea of how you're going to, easily transition that to your loved ones or nonprofits or wherever you want those funds to go.
So personally, Sam, as an advisor, I've seen a lot of really sad stories resulting from someone not having any planning. How about you?
Yeah, I got to tell you, I have seen situations where people have accidentally disinherited part of their family. I've seen situations where they handcuffed the money to a degree that the very people they were trying to benefit couldn't get out of the institutional trustees. I've seen so many different issues where poor estate planning has negated the benefits they were trying to create in the first place, that it almost would have been better if they didn't do it, just to start with. So you have to be really intentional and thorough in your methodology and how you construct it.
So getting your estate plan done correctly is really about not leaving a mess, is what it sounds like you're describing.
Yeah, it's really about protecting the very loved ones that you're trying to benefit. But a thorough estate plan isn't just about where the money goes after you die. There's a lot of things that you need just to take care of you while you're living as well. I remember one story where, because a couple failed to have a power of attorney document for finance, there was a situation where one of them actually needed to have some additional medical work done, and they couldn't get the equity out of their house, which was one of their largest assets. So there's a lot of things that kind of go into it, both to protect you while you're living, as well as making sure that there's no arguments or contention or fighting once you're gone.
Sam, it's a great having you on the show as usual. Thanks so much.
Thanks for having me.
We have a guest coming up who's actually a estate planning expert in his own right, and that's, no pun intended, David Wright. David is the founder of Wright Financial Group in Toledo, Ohio, and has been helping clients navigate these types of issues now for over 30 years. He's an income specialist, of course, with our very own retirement income store, and he's also an investment advisor representative. Dave, thanks so much for being such a good friend of the income generation.
Thank you, Dave. Thank you for having me. Hi, Jeff.
So Dave, why is basic estate planning a good financial plan?
It's a good financial plan because you want to have a well-coordinated plan, one that has income, certainly, but you want to make sure that that income continues after you're not here anymore. Obviously, people need to look at beneficiary designations, and we do that all day long with IRAs and 401ks and all that stuff. But if you're really doing your job as a fiduciary, you take a look at the entire client's net worth, what they have in real estate, rental property, making sure all of this stuff passes adequately at death with the least amount of taxes and minimizing probate along the way.
So you said something really important about minimizing taxes. And so most people won't have an estate tax, Dave. You got to be worth more than, 10 million plus to have an estate tax. But a lot of people will have income taxes on their assets, correct?
That's true. I mean, when they pass property, obviously some property gets a step up basis at death. But obviously, if they've got bank accounts, brokerage accounts, things that aren't titled properly, they can be in a position where they are going to be paying some income taxes in respect of decedent, also some other probate costs that they could avoid. And another thing that I see quite often, Jeff, is people don't take the time to update their durable powers of attorney as well as their living wills. They got to make sure that these things are current, just as much as every 2-3 years, making sure that their property is going to pass and the documents are up to date. Because if you're not here to take care of your own events, if you're sick or under the weather, you got to have somebody be able to step in and help you with medical decisions as well as financial decisions on your assets.
As usual, it's been our pleasure. Thanks so much for joining us.
Righto. Good seeing you guys.